they spend the money on one of two things. See, either they will spend it on buying an asset, or they will spend it on some recurring expense. They may pay rent, they may pay the telecom charges, it may be something to do with the factory expenses. These are expenses which will keep recurring. So that sort of expenditure is referred to as expense, where it is of a recurring nature. But the other expenditure relates to where we actually purchase assets. So this is one point I had made. I also told you that balance sheet has two aspects, liabilities and assets. Liabilities are basically sources of funds, and assets are the application of funds. So liabilities, if I look at a list of liabilities of any company, it is basically answering one question. The question is, where is this company getting its funds from? Where is it getting its funds from? This is the basic question you get an answer to when you look at liabilities. And when you look at assets, it tells you how it is using those funds. What has it done with that money? This was one point. The second thing was, we looked at this particular sheet here. And I showed you here that, let me just go through this again. So, as you can see, sources of funds, you have the long-term sources. So, first of all, there is the equity capital, all the shareholders of the company who are actually owners of the company. These people are owners of the company to the extent of their shareholdings. And apart from that, you have the money that this company has borrowed. Company has borrowed money. It may have borrowed from bank. It may have borrowed from, let's say, bondholders, individuals contributing to the company, and they get a certificate. And in that certificate, it says that, look, we accept your money, we'll pay you so much interest, and we'll return the money to you after, let's say, 5 years or 7 years, something like that. Now, this was one part. After that, you have other liabilities which occur when the business actually starts. See, with the long-term borrowings, you buy the land and buildings, the machinery, the office equipment and furniture. You do all these things, you get your business running. And then, when you start your business, certain things will begin. These finance sources are short-term. For example, you may take a cash credit or an overdrawing account from a bank where you can take money, use that money to buy raw material, use that money to basically run your day-to-day business, pay the salaries, interest, rent, etc., etc. And then when the sales come in, you have to deposit that again in the bank. This is how it works. So this sort of liability, where you borrow and you use it for a short term, that is known as a current liability. And similarly, you create certain current assets. For example, the cash that you have in your bank, the stock of goods that you have, the raw materials that you have, the work in progress, the finished goods, all that constitutes current assets. Apart from that, you must understand that whenever sales are made, these sales tend to be credit sales. When bulk sales are made, it is not like us going to a shop and buying something. Where you buy, let's say you go to a Reliance Mart, you buy a number of things, you go the billing counter, they give you a receipt, you pay. It's not like that. In the case of the bigger companies, what will happen is, or let's say bulk orders, the payments are always made later. The deliveries are made first. The goods leave the factory, they go to the buyer's place, but the payments are made much later. And therefore, it creates a certain category called bills receivable. That means these are bills which have been drawn by the company on some buyer. The buyer has undertaken to pay it. and the company will receive the amounts of these bills in the future. This is how it actually works. Now, anything in the current asset category means that it can be converted into cash in 1 year. It is like, for example, you look at the non-current assets like land and buildings, machinery, office equipment. Even if you were, first of all, you don't want to sell this. So there is no question of converting it into cash. This component here, the inventory, the bills receivable, these are things which you want to convert into cash. This is the whole idea of the business. Now, these are the sales. You have to convert it into cash. Now, the process of converting it into cash cannot take more than 1 year. That is why it is known as a current asset, something which can be easily converted into cash. Similarly, a current liability, like the cash credit account or the bills payable. For example, you have bought raw materials from certain suppliers. They also don't insist that you pay them immediately. Even for them, they will give you a certain number of months in which to pay. Therefore, they will draw bills on you. You are expected to pay those bills within a certain period of time, and those are called bills payable. Now, these have to be paid generally within the contract period, whatever it is, 2 months, 3 months, but it will never be more than 1 year. Therefore, these two categories, the current liabilities and current assets, these represent dues which either the company has to pay or is going to receive within 1 year. This is the thing which you need to remember. And this is the lifeblood of the business. This is what is known as working capital. This is how it actually, the business, this is how it works. Then we look at the profit and loss statement. Now, the profit and loss statement is also known as the income statement. Okay. Now, income or revenue is the amount of income generated by the business. First, understand this. The sales figure of a company is shown as income. For a manufacturing company, the sales of its goods will generate income. For a software company, the sale proceeds of its software programs, license fees, whatever services it is giving, that will be income. This is the meaning of income here. For a company like Reliance Mart, it would be the sales proceed of the goods that it stocks. So, for example, it's a trading company like Reliance Mart. It's not manufacturing anything. It's buying from a wholesaler, selling it to customers. So, the payments which you are making, the sales which it makes, that is income. If it is like, let's say, Tata Steel, it is manufacturing steel, it is selling that, then the sales of the steel is income. So, income is not profit. From the income, the expenses will go, and then you get what is known as profit or net income. So, just get the terminology clear. Income is any money flowing into the business, but it does not mean that income is profit. It means simply that this is money which has come into the business because the business has sold something. It has either sold a service or it has sold. And expenses on day-to-day operating expenses are recorded in the profit and loss statement. So remember, the profit and loss statement, only the, let's say only the expenses will be recorded. If the company spends money on buying assets, that will not come in the profit and loss statement. It only the recurring expenses are actually recorded in the profit and loss statement. You have to understand this. Whatever assets are created, if there is an expenditure, if there is an outflow of money for the purchase of certain assets, that it will only be reflected in the balance sheet of the company. So where the land and buildings, machinery and office equipment and furniture and all those things are there, in that there will be a reflection that yes, the company has bought something. But in the profit and loss, it will always deal only with expenses of a recurring nature. Now to understand this, you look at this particular statement here. Now, we are looking at the income side now. Okay, now the second thing to note here is, this is for 1 year. See, the balance sheet which we saw, that is a snapshot of the accounts of the company, of the assets and liabilities of the company as on 1 day. On any given day, like suppose, for example, you want to draw up a personal balance sheet, any of you. What will you do? You will sit down and you will look at what assets you have today. Okay, so maybe you have an insurance policy, maybe you have a motorcycle, you have, let's say you put a certain amount of value to personal jewelry, you put a certain amount of value to any assets which you have. That is one side. The other side is, if you have borrowed money, let's say you have a personal loan, that is a liability. And then you simply say that these are my liabilities, these are my assets. Assets minus liabilities will give you a net worth. You write your net worth there and your both sides will balance. That is your personal balance sheet. In the case of a company, what will happen? They will write all their assets. They will write the land and buildings. They will write the office equipment, the machines, etc. They will write all the current assets. They will write all the liabilities, and that will become their balance sheet as on a given day. Just like if you people were to draw up a balance sheet of your own, you can only do it as on a particular day, because your bank account balance will keep changing. You may make a payment on Amazon, you may sort of order something from Swiggy, something can happen, your bank balances, your bank account is going to change. So the accurate picture of your balance sheet can only be made out for a particular day. In the case of companies, that day is the 31st of March. That is the end of the financial year. The profit and loss statement, on the other hand, is a record, is like adding all the transactions which took place in income, all the transactions which took place in expenditure over the entire year, right from 1st April till 31st of March. So let's say if you're looking at the last year, it will be 1st April 23 till 31st March 24. In the current year, you cannot draw up a profit and loss statement today, because today is the 20th of April and the financial year began on the 1st of April. This year's profit and loss statement can only be prepared on the 31st of March 1925. It can't be done before that. So when we say profit and loss statement, please remember this is a record of the transactions in income and expenses for the whole year first. Now the income side, like I said, sales to the cost of goods sold. Let's say it's a manufacturing company. You sold finished goods worth 10 lakhs. But the cost of making those goods was 6 lakhs. So that is referred to as the cost of goods sold. It's also referred to as COGS, like that. COGS includes cost of raw materials and labor related to the production of goods. Okay, it doesn't include like marketing expenses, other stuff which are genuinely expenses. Now look at what happens now. You will get a figure called the gross profit. Is this the profit that the company has made? Actually, no. This only tells you that from the sales of goods that the company made, let's say it was like Tata Steel is making steel. From the sale of steel, what is the profit that they made? So the cost of making the steel, the actual amount received by selling the steel, you'll get the gross profit of Tata Steel. But the other expenditures which you can think of, for example, rent. Whatever premises you have, there'll be a certain amount of rent that is paid. Power, electricity. salaries and wages. You have people who are working for you, who are actually running the machines or the computers. You have to pay them salaries. The marketing expenses, those advertising campaigns, which every company has to do, and which today represent very substantial expenses. If they have borrowed from a bank, so the interest expenses of that particular year, of 1 year, the depreciation. Whenever you use an asset for 1 year, you reduce the value of the asset notionally, in the sense that the asset is subject to wear and tear. Every year, every asset will lose a part of its value because it is aging, because you are using it. It's just like if you have a pair of shoes and if you keep wearing it every day, the soles will gradually become, it will become scuffed, it will be, let's say, damaged. So with, let's say, every month that if you're using the same pair of shoes, what will happen is that there'll be a certain amount of wear and tear. So depreciation of the shoe would be that if the cost of the shoe is, let's say, 1,200 rupees, and you say the life of that shoe is 1 year, then every month it is losing a value of 1,200 divided by 1,200 rupees. By the end of the year, the shoe is now no good. It has lost its value, and you now have to buy a new shoe. Think of it like that. The company has a machine. The machine has a value of, let's say, 50 lakhs. And let's say the machine has a life of 10 years. Then 50 lakhs divided by 10 means 5 lakhs. That 5 lakhs is considered to be the amount by which the value of the machine has reduced over 1 year. Okay? That amount is referred to as depreciation. Now, as you can understand, this is an accounting entry only. This is not something which is actually, that 5 lakhs is not money which is going outside the company. For example, every other expenditure here is an outflow. Money has gone out of the company. If you've paid rent, money has gone out of the company. The same stands for power, salary, marketing, interest. In each case, you are actually paying money. Your bank account will be reduced by the amount you have paid. But in depreciation, that is not happening. But why do we do this? Because we want to reduce the actual profit by this amount. Because if we don't do this, what will happen is, after 10 years, when that 50 lakh machine suddenly has a value of 0 and I have to replace it, suddenly, at that point of time, I will have to show that the entire value of the machine has gone in the last year, in the 10th year. And the company will go into a loss. So the smart play is every year reduce it by 5 lakhs. It will be easier. In this case, these are smaller numbers. It is reduced by 5,000. You will need insurance. That is 5,000. Conveyance, cars, trucks, whatever. If you add all this, you get the total operating expenses, which is 161,000. 1,61,000. These are the operating expenses. These are the expenses which are actually required to run the company on a day-to-day basis. Okay. Now, if I take this 4 lakhs and I reduce this 1,61,000, what am I left with? 239. This is the profit from the business. This is how it works. So we sold goods for 10 lakhs. Out of that, 6 lakhs was the actual cost of making those goods. We are left with 4 lakhs. Then the actual cost of running the company was 1,61,000. We reduced that from 4 lakhs. So we get an operating income of 2,39,000. Now, in this income, no other income is being included. It is only the income which is being generated by the business. Now, there are certain expenses a certain income called non-operating income. Let us see the example here. Interest on investments, 51,000. So the company, the owner of the company, they invested some of the company's money in, let's say, buying bonds of some other company. They invested it there. They had surplus money. They couldn't think of any way of using it in their own company. So what they did was they invested it in some other company. That company gave them an interest of 51,000. So since the money which was invested belonged to this business, therefore, the interest will also be credited to this business. It will be given to this business. It will be shown in the books of this business. Now, if you look at this, you earn 2,39,000 here, which was profit from business. And then you earned 51,000 from investments which you made, but which are not part of your direct business. Let's say if in the case of the Tata Steel example, it has nothing to do with making steel. Let's say Tata Steel had invested in Infosys and Infosys gave it this amount. Then this is the amount which it earned there. Now you get the net income. What is the net income? 239,000 plus 51,000. You get a net income of 2,90,000. This is the profit and loss statement. I hope you all understood this. Anybody with a problem? Can you just put any comment on chat? Are you all clear? Just give me a thumbs up or something, since I'll be able to see it then. Okay. So we can move on to the next part here. Now we come to what is known as the cash flow statement. This is the third important statement which is mandatory. That means it is compulsory for the company to prepare this particular statement. Now, what is the cash flow statement? It deals with inflows and outflows only of cash, no credit. So let's say that you bought something on credit for 5 lakh rupees. That transaction will not come here. You sold something on credit for 2 lakh rupees. That transaction will not come here. The only transactions which will come in a cash flow statement will be those which have been paid for upfront. If you sold something, you received money for it. If you bought something, you paid money for it. Basically, like us. For example, whenever we buy something, we pay money for it. If we sell our own services, we get paid for it. So there is there's no receivable in our individual accounts. This is like that. So this cash flow statement is divided into 3 sections. First, you have cash from operating activities. Then you have cash from investing activities. And then you have cash from financing activities. Now, what are these 3? The first one, the cash from operating activities, inflows or receipts of cash. What are these? The sales. Like, for example, all the sales that you made for which you received cash, or it may be credited in your bank, it doesn't matter. Cash simply means that it has been paid to you. If you got a check for it, we are assuming the check did not bounce. You actually got that money. So this sales is the inflow into the company. Cash from operating activities, the payments by side. What is that? Any payments in cash you have made to your suppliers for things you have bought from them. And any payments which you have made for the operating expenses, like the rent which you paid for the premises, the power bills, the salaries, the insurance, all that. Depreciation, remember, will not come. Because in depreciation, no cash payment is being made. Correct? So this is the operating activity part. Now, investing activities. Investment here refers to purchase of assets like machines, computers, etc. So suppose you buy a machine. and you pay for it in cash. That is a outflow of cash. So that is one thing which will come here. You invest in a bond or share of another company. You can do that. No? You can take some money from your own company and you can go and buy the bond in another company. If you do that, you'll have to pay that company. So when you pay that company, there is an outflow of cash. There is no credit here. Then, if you sell any asset, let's say you have a machine which has become old. You don't want to use it anymore. You call the junk guy, the kabadi wala comes, you sell the machine. If you sell the machine, what will happen? Some cash will come. So in those cases, also this will be under investing activities. Then you have cash from financing activities. Every time you take a loan, some money is going to flow into your business. The bank is going to give you a loan, money. That money will come into your business. So that is an inflow of cash because of an financing activity. Similarly, if you repay a loan or you pay back interest, then you are making a payment, which essentially is a outflow of cash. You understand? All these examples which are here, let's start again from this place here. Operating activities, 2 categories. All the sales that you make, which are cash sales, no credit here. Those are inflows of cash from operating activities. All the payments that you make to your suppliers, all the payments that you make for operating expenses, these are all cash payments. These are outflows of cash from operating activities. So you have your 2 basic points, inflows and outflows in operating activities. In the investing activities, every time you buy an asset and there is an outflow of cash, you are creating an outflow. Every time you sell an asset, you are creating an inflow. Every time you invest in another company, buy a bond, share anything, you will create an outflow. Similarly, when that bond is repaid to you, when that bond has, let's say, a life of 5 years and that company returns the money to you, it will create an inflow. So that is the investing activity. And financing activities, every time you borrow money, there will be an inflow. Every time you repay money, there will be an outflow. Now, all these things have to be shown in a particular way and it is known as a cash flow statement. So what does it look like? So here's what's known as the direct method. So it looks like this. Cash received from customers, 10 lakhs. You can assume these are sales. Cash paid to suppliers, 2 lakhs. Remember, we said payments to suppliers are outflows. Money received for sales are inflows. So let me switch on the fan, please. Okay. You bought something from your suppliers. This, you've paid them. It's an outflow, 2 lakhs. You've paid salaries, 1,50,000. You've paid other operating expenses, rent, power, insurance, all that. That's 50,000. So your net cash from operating activities is 6 lakhs. How did I get 6 lakhs? The total of this is 4 lakhs. This is 10 lakhs. The inflows are higher than the outflows. Therefore, the 6 lakh is shown in the inflows column. That means the total amount of cash generated by the operating activities is coming to 6 lakhs. Now, investing activities. Sale of land. The company had some land. That land has to be in the name of the company. And it decided to sell the land. When it sold the land, an inflow of 5 lakhs happened. Purchase of equipment. Okay, they bought some, let's say, equipment. It could be machines, it could be computers, it could be anything. That's 6 lakhs. They paid for it in cash. So that's an outflow. Net cash is what? 5 lakhs and 6 lakhs. 6 lakh going, 5 lakh coming. So 1 lakh. Outflows are higher. So I show the 1 lakh here. Then financing activities. Dividends paid. You made a profit. You had to pay your shareholders dividends. You paid 1 lakh rupees as dividends. That is 1 lakh of cash moving out of the company. You paid your loan installments, 50,000. The net cash here is 1,50,000 of money going out of the company. Therefore, that is an outflow. Therefore, it's shown under the column outflow. Now, what is the amount that the business actually is getting? 6 lakh here is inflow, extra inflow. And here 1 lakh and 150, these two are net outflows. If you add these, you get 250. This 6 lakh minus 250, you get what? 350. This 3,50,000 is actual cash which has gone into the business from outside. Do you understand this, everyone? Kedar, clear? Okay, fine. So, at the end of the whole thing, you have 6 lakhs, 2,50,000. The net cash that you're getting from the business is 2,50,000. This is a simple cash flow statement. So the main statements that the company is expected to make are the balance sheet, the profit and loss, and the cash flow statement. So if you look at the, let's say, the one simple way of testing this is now, you just write cash flow statement of, name any company, Tata Motors. Put this on Google. Most probably, when the results come, the search results, the first one will be moneycontrol.com. When you click on that, it will show you the cash flow statement of Tata Motors. If you, instead of writing cash flow statement, you write profit and loss statement, Tata Motors, and you put a year, 2021, 2022, 23, something like that, it will immediately take you there and you will see that the figures are there. And if you use what I have given you, broadly speaking, you should be able to generally understand what those figures are all about. It will not be very challenging. Okay. Now, that's one part. Simple thing that we've understood the 3 types of statements. Now, the next thing we understand is, see, there is something called in finance or in simple arithmetic also, you may have, if you remember your maths in school, somewhere down the line, you would have studied something called ratio and proportion. Ratio and proportion is basically what? It's basically comparing 2 things. I have A and I have B. How does A compare with B? A divided by B, what is the figure? Now, this concept is used a lot in finance. What you do is, if you begin to look at 2 different items, generally one from a balance sheet, one from the profit and loss, it begins to give you an idea about the efficiency of the company, about the profitability of the company. It tells you a lot. So, for example, with the help of simple ratios and a comparison of the ratios with the previous year, we can see whether the business is doing better or is not doing so well. So one thing you remember is this word comparison. So first of all, we are going to take ratios of one company, and then we will compare this with the ratios of the same company for the previous year. It's, so you can then see when you compare, is the company doing better or is it actually declining? What is the actual performance of the company? Generally, we look at 4 types of ratios. So the ratios themselves are grouped into 4 categories. The first one is profitability ratio. The second is called the liquidity ratio. So liquidity means how easily can the company get cash? How easily can it generate cash? That company has certain current assets. It has, let's say, it's produced certain finished goods. They have to be sold. It has sold certain goods to some buyer, and they have promised to pay. So these things, how long will it take to convert it into cash? Leverage ratios, this we'll see, and efficiency ratios. So profitability ratios will answer the basic question, how profitable is the business? For example, the purpose of a business is what? Basically to make profit. So is the business making profit or not? Question number 1. Number 2, is it making more profit or less profit than it made last year? 2. 3, is it making more or less profit than its competitors of the same size? Let's say this company, 10 crores of money was spent to basically put up this company, to make it actually begin to generate goods and sell goods and produce goods and sell goods and all that. Now, from 10 crores, let's say it's getting a profit of 1 crore. What about some other company which is also a 10 crore asset company? That company also, to get that company started, it took an investment of 10 crores was made. How much profit does that company make? Does it make 1 crore? Does it make 2 crores? Does it make 50 lakhs? So compared with other competitors, how good is my company? That is this profitability ratio. For example, profitability will have something called gross profit as a percentage of sales. So remember in the last, the profit and loss I showed you, I said sales are 10 lakhs. And the gross profit was 4 lakhs. So in this particular case, it's like saying 4 lakhs divided by 10 lakhs multiplied by 100, which will give you 40%. So essentially what it means is, for every 10 lakhs of sales, the company is able to get a gross profit of 4 lakhs. This is the ratio. One item is my gross profit, one item is my sale. Now, there may be other companies which can generate a 4 lakh profit from only 8 lakhs of sales. My company, it takes 10 lakh of sales to get 4 lakhs of gross profit. Now, if there is another company which is also making 4 lakhs of profit, but it is getting it out of just 8 lakhs of sales, which company do you think is more efficient? So the company with the higher profit margin is obviously doing better. That's one thing to remember. Now, net profit. Net profit is which one? The operating profit. After everything was, all the operating expenses were reduced from the gross profit, what did we get? We got the operating profit. That as a percentage of sales. For example, in our case, our profit, if I remember, was 4 lakh minus 161. It was 239. 239,000 of profit we were generating from 10 lakhs of sales. The last statement which I showed you. So if I am getting 2,39,000 profit from 10 lakhs of sales, if I want to look at this as a ratio, it is 23.9%. I'm basically getting 23.9%. That is my ratio. 2,39,000. So after selling 10 lakhs of goods, I was able to get a profit of 2,39,000. What is my profit percentage? It is 23.9% or just short of 24%. Is this good? Is this bad? How do I know? If I just look at this figure in absolute terms, it doesn't tell me too much. But if I look at what figure the company had last year, then I have an answer. Like, for example, last year, if it had a net profit to sales ratio of, let's say, 20%, and this time it's doing 23.9, then I can confidently say that, yes, we are doing better this year. But if last year it had done 25, and this year I'm doing 24, then I know that something somewhere is not as good as it was last year. So from a management perspective, the people who are actually running this company, this ratio analysis becomes very critical. It's like a performance appraisal of the company. How good is this company actually doing? Then return on equity. See, net profit as a percentage of equity capital. Remember, equity capital means the total amount invested by the shareholders. Now, they are the owners of the company. All the shareholders together are the owners of the company. So the owner's capital, what is the net profit that they got? Let's say that they invested 5 crores. And from that 5 crores, they find that the net profit they have actually got is 50 lakhs. So they will say that, yes, we have got a net profit, or the return on equity is 10%. So the people who invest, they are interested in knowing what is the amount of profit the company in which I invested in, what is the amount of profit that it generated. So this is again very critical. See, if you invest in something, you will understand the importance of this. If you, let's say, partner with someone in a business, let's say you're not running the business, but you give capital. 50 rupees you give, 50 rupees your friend gives, and your friend actually runs the business. At the end of the year, you'll want to know how much profit did you make. And let's say the guy says, I made 5 rupees profit. So you now know that 50 plus 50, 100 rupees was there. Total investment in the company. You invested 50, your friend invested 50. From that, the profit which was generated was 5 rupees. That means your share is what? Half of that? 2.5. So 50 rupees you give and you get just 2.5. So for you, it's a bad investment. You haven't got too much. But you will only know this after you do this analysis. Practically speaking, what you have just done, you have calculated return on equity. Total equity of that little company of yours, 50 plus 50 was 100. The total profit which is generated was 5. So that's like saying 5 out of 100 or 5%. So the return on equity was 5%. What this tells you is that it's a very bad company. It's not doing well, because you could have made much more money by simply putting that 50 rupees of yours in the bank, where you would have got 7%. So return on equity actually tells you how much money did the owners make? What is the return that they are getting? So it's a very critical ratio there. And then there is another ratio. This actually is a reflection of the efficiency, but it's also profitability. With the capital the equity that you gave, equity, remember, are liabilities, you created certain assets. Now, of these assets, what is the ratio of the profit to assets? Because ultimately, the assets that you have, like the machines and all those things, the equipment, those assets are responsible for the production or the manufacture of the goods. And it is the sale of those goods that give you your income. And your net income is basically that same income minus the operating expenses. So when I look at this figure, net profit to total assets, what it is telling me is I created 100 rupees of assets. From this, I got 5 rupees return. Okay. So so we look at examples, but these are examples of profitability ratios. In this slide, we look at liquidity ratios, leverage ratios, and efficiency ratios. Now, liquidity ratios are how easily can the business generate cash. So I look at my current assets. Current assets, remember, was what? Cash, inventory, that is the stock of goods that I have, and bills receivable. That means I have certain, let's say, documents with me which show that the credit sales that I have made, the amount of sales that I have made to somebody on credit, they have undertaken to pay me that. So I have their signatures and they say that, yes, we have received 5 lakhs of goods from you. We will pay it to you in 2 months. Those are liabilities. Current asset side, these are assets. Current liability side, you have bought certain things from suppliers, raw materials, let's say, and you have undertaken to pay them in 2 months. Things like that. Liquidity basically is the amount of money that you're going to receive as a proportion of the amount of money that you are expected to pay. And remember, these are all short term. Current liabilities, current assets, which we said these are all due in 1 year. So if you look at it, just common sense, I should be receiving more than I am going to pay out. Because if I'm receiving less than I'm going to pay out, then that difference, if I have to pay 100 and I'm only going to receive 90, then that 10 rupees I'll have to get from somewhere else. And that is not easy in a business because all money is tied up. So common sense says that I should be in a position where I am going to be receiving more and I'm going to have to pay less. If this is not the case, then something is very wrong with your business and then your liquidity position is very bad because then you'll always be short of cash. But this ratio, this is a good one here, is 1.50. That means if I am going to receive 1.50 rupees, say lakhs, 1.5 lakhs, then the amount I'm expected to pay is 1 lakh. So I have a margin of 50. See, all the money that I'm expected to receive, I will not get immediately. I have sold goods on credit. People have promised to pay me in 2 months. But there will be 1 or 2 guys who won't pay. They may ask for more time. There may even be a case where 1 or 2 guys, one chap will simply not pay. And I'll have to write his debt off. That means file a case against him, but I'm not getting the money right. Now, current assets minus current liabilities is a liquidity ratio. It tells you how much cash you can generate. Leverage ratio. How much has the business borrowed? Remember, in the balance sheet, we're looking at equity and long-term borrowings. So debt is long-term borrowings. Equity is the actual owner's funds, the shareholders, the amount of shares they bought. If I look at these two, what is the ratio? This is important. You may feel, I think, as a layman, you will probably feel that my equity, that is my own funds, should be more than my debt. And I should borrow less than the actual money that I have. For example, in personal finances, you would never want to borrow more than you actually have. Or no bank will also be able to give you more than you actually have. But in business, it is normal to borrow more than the capital that you have. So let's say you have a capital of 100, it is okay to borrow 200. It is sometimes okay to even borrow 400. Just as long as you are in a position to take that borrowed money, use it in a profitable way, generate enough money to pay back the loan. So when I look at debt equity ratio, I am basically looking at how much money I have borrowed as a proportion of how much money I own. How much money do I own? It is the total amount of shareholders' capital. What is the money that I borrowed? Basically, I've either borrowed it long-term from a bank or I've borrowed it from individuals by giving them instruments called bonds. That's all. I'm looking at this. What is good, what is bad? There is no magic number here. When I was in the bank, we used to be very conservative and we used to say that 2:1 is how much the bank likes. So if you have 1 rupee of capital, you can borrow 2 more. But there would always be companies which were borrowing more than 2 and they were doing well. So there is no absolute number here, but at least it will tell you that, look, this is the amount you are borrowing and this is what you have. If your business tomorrow gets into trouble, then if you have borrowed too much, all your assets will get sold just to pay off what you have borrowed. The other leverage ratio is when I compare the total assets that you have to the equity. Let's say, put it like this. Let's say my total assets are 200 and my equity is 100. That means my own funds are 100. But the assets that I have created are 200. Where did the other 100 come from? I borrowed that 100. That's why I got it. So this is another way of looking at the same thing. What does it tell me? It tells me the extent to which your total assets are actually financed by the owner's capital itself, and the extent to which it has been financed by borrowed funds. So the whole idea is that as an owner of the company, I understand what is the amount of money that I have borrowed. Then you know whether you are, how much trouble you can be in if the company actually fails. Just think of the, let's go back to the time when COVID was a big problem. Okay, March 2020. COVID comes. And there are companies which have borrowed hell of a lot. Let's say they had a capital of 100 and they had borrowed 300. And the company was running. It was okay. It was producing goods, it was selling goods, everything was going fine. And then COVID came. And the moment COVID came, the supply chains got disrupted. So they were unable to get raw materials, components, whatever they needed to make the goods that they were producing. Number two, whatever goods they had, they were unable to sell the goods because the transport, communication, all that had got disrupted. There was no way of shifting goods from your factory to persons who needed the goods. The result of this will be what? The company will not be getting any revenue. Since it can't sell, it can't get income. But the banker who has given funds to the company, that banker is going to demand his money. That banker is going to demand his money. And where will the company give it? They can't. So initially, the companies, they requested the banks, look, we can't make any sales. We don't have the money to pay. So please give us more time. So the banks went to RBI, and then RBI finally said, okay, fine, we'll give them more time. That time initially was given for about 6 months. After 6 months, when it still didn't work, they again wanted more time. But ultimately, it created such a big problem for these companies that many of them went out of business. Ultimately, they reached a stage where they were unable to pay even the interest on these loans. The bank began to take legal action, and finally, the companies had to close down. I think the most visible sign of this, which all of us have seen, are the many restaurants which closed down, the many hotels which closed down just after COVID. Because as travel and eating out and these things became less possible, the revenues of these type of businesses, they absolutely folded. Tour operators, they went out of business. So these people who had high debt, why am I talking about this? These are businesses which had high debt. They had borrowed a lot, but suddenly landed in a problem where they were unable to generate income. These businesses suffered. So when you take debt in good times, when the economy is booming, when sales are good, you will make a lot of money. But in bad times, when your sales are not there, it can result in the whole business going bankrupt. That is the thing with debt. And that is why it is good to monitor it and know how much debt you have taken. Okay. So a simple example here, if total assets are 10, equity is 5. So where did the rest of the money come from? It was borrowed. The total assets divided by equity ratio is 2. The owners have assets that are double their own investment. This is called leverage. So you're using 2 to get 2 more. Like that. Then you come to what are known as efficiency ratios. Efficiency ratios is how much time does it take me to convert my inventory into sales. I have finished goods with me. I sell these on credit. How much time does it take me to convert it into cash? That is what inventory to sales is. How long does it take to sell an average stock of inventory? I have finished goods. How long does it take, to sell it? So obviously, the faster, the better. So the faster I can turn my turnover is what? From cash to cash. Cash, raw materials, processed, finished goods, sales, credit sales. Then my debtors pay me back, I get cash again. One cycle is complete. The faster this cycle takes place, the better, the more efficient I can consider my company. The longer it takes, that means my money is tied up. See, you have invested money. You will not get your money back along with the profits till that cycle is complete and all your debtors have paid up. And all the people to whom you had sold on credit, they have paid you back. So the faster these ratios normally are in days. You have to calculate it in days. Okay, how many days does it take? That is the basic. These are the main ratios here. Now, here I'm showing you some of the ratios on this particular sheet. So this is a simple analysis of a company over a 3-year period. Okay. Year ended 31st March, 19, 20, 21. And how do we understand this? It's like this. The actual sales made by the company in 2021 was 15,000. Previous 2 years, 12,000 and 5,000. The cost of goods sold, remember the cost of producing these goods which were sold, was 9,300 in 2021, 9,000 in 2020, and 4,100 in 2019. So, if I look at the percentage here, of this is to this. This is 62%. That means the cost of goods is 62% of the sales. The cost of goods here is 75% of the sales, 9/12. And the cost of goods here is 82% of the sales. So what is the gross profit? 15,000 minus 9,000 is 5,700. What is the gross profit ratio? That means gross profit as a percentage of sales. 5,700 as a percentage of 15,000. It is 38%. Here, 3,000 as a percentage of 12,000. It is 25%. Here, 900 as a percentage of 5,000. It's 18%. Operating expenses is 2,500 for 2021. That means profit before tax is 5,500. 700 minus 2,500, which is 3,200. This, if you take it as a percentage of sales, is 21%. Where am I getting this? 3,200 divided by 15,000. So 15,000 of sales gave me a profit before tax of 3,200. In the second case, 2020, 12,000 of sales gave me a profit before tax of 1,300. And in the third year, I ended up with a loss of minus 300. So if I look at it now in terms of ratios, what am I getting? The first year, okay, most recent year, 2021, I'm making a profit of 21%. Second, 2020, it was 11%. So it was pretty, there's a good increase here. And in 2019, I was in loss of 6%. Because you see, this is a negative figure. So I was actually making a loss. Now I paid taxes. So I paid taxes, 3,200. I paid taxes of 1,280. I'm left with a profit before tax of 1,920. So now 1,920 as a percentage of 15,000 is 13%. So my actual profit, the profit which I'm getting after paying all taxes, is 13%. So you can see how I began at 38, came down to 21, and finally the take-home part is 13. For the other years, it is 7. And obviously, if you make a loss, you don't pay tax. So that whole thing is over. This is a simple analysis of the company. So what this is telling you is that if I take all the figures from a profit and loss account and arrange it systematically, then in this single 7-column statement, I am able to get a very good idea about the profitability of the company. Excuse me. I get a very good idea about the profitability of the company for 3 years. So this is what actually ratio analysis helps you to do. It's giving you a snapshot of the company's performance over a 3-year period by simply taking the figures and arranging them properly. Okay. Now, the success of a business requires the entrepreneur to manage all aspects efficiently. And this, what we're looking at now, is called the operating cycle. We mentioned this. You'll see it now. So it starts here. There's any business, it will begin with cash, because you will need cash to buy something, to set your business up. All the land, building, machines, assets, equipment, everything you have is coming from here. Now, you create your factory is in place. You get your current assets. A part of the current assets, the one which is very important from an operating cycle point of view, is your inventory. That means the raw materials that you have bought, which have to be processed and converted into finished goods, that part. Then When you buy inventory, you create current liabilities. Why? Because you buy inventory on credit. Your suppliers from who you're buying those raw materials which you will process, they sell it to you on credit. So the moment you accept that credit and the goods come to you, you are creating a current liability. That means this is something which you have to pay in the future. Okay? Then you sell. The inventory is processed, it's converted into finished goods, and you sell. But when you sell, you also sell mostly on credit. So when you do that, you create basically what a category known as sundry debtors. Debtors. These guys have to pay you money. So these are your current assets. These are your current liabilities. Okay? And these receivables that you have, the debtors, the receivables that you have, goods that you sold on credit, and for which you have to receive money, these will have to be converted into cash. When will they convert into cash? When these people who have bought goods from you on credit, they repay the money to you. They pay the money to you. When they pay the money to you, you get back the cash. So this cycle gets completed. You began with cash. Ideally, you will end with cash. If you don't end with cash, then you're in big trouble. Let's say you began with 1,000 and you ended up with 700, then you're losing money. So this cycle, from an efficiency perspective, what you should notice, how much time does it take? From going from here and making this whole round and coming back here, how long does it take? Because once you get back the money, this cycle will begin all over again. Once again, you can buy raw material, convert them into finished goods, make the sales. You will have receivables. You will then, the receivables will get paid and you will get cash again. So that cycle will go. The faster it is, the more, let's say, turnover you will have in 1 year. If it takes, let's say, 6 months to complete, then you will have 2 cycles in a year. But if it takes just 3 months to complete, you will have 4 cycles in a year. So you can see from common sense that the more cycles you have, the more profit you will get. So for every business, it is better that this process, the amount of time which is spent on an operating cycle is less. Okay? Shorter the operating cycle, the more turnover the business will have, and the more turnover it has, the more money it will make. So see, here I've tried to flesh it out for you. So inventory, raw materials, goods being processed, finished goods. The time taken to convert the goods into the final product is critical. Less, the better. Then this one, sales. It takes time to sell goods. How fast the goods are sold depends on the orders that are generated by the marketing department. Receivables, only customers with a good market reputation should be allowed to buy goods on credit. If you sell your goods to anybody, even those with a bad reputation, what will happen? Everybody will buy from you. Your sales are going to be excellent, but you won't get back any money. You'll create receivables which will never be converted into cash, because those people will simply tell you, we don't have the money to pay you. Okay, so this is your operating cycle. I'll be sending this to you today. So once you get this part, if you look at clearly now, the financial statements which I showed you and this, it gives you a very concise idea of the financial side of a business. Okay. Now, let's just look at this working capital part a little more closely. So working capital is the money required for running the day-to-day operations of a business. As we saw in the operating cycle, a business begins with cash, the current assets, buy raw material, other materials required to make its product. And when they buy, they create current liabilities. Next, the business processes the raw material, for which there is a labor cost, fuel for the machines, electricity for the factory premises, etc. All these have a cost. This is what the working capital is required for. Typically, the labor and fuel costs will be paid later. Prior to their payment, they are current liabilities. So remember, all the salaries, the labor payments, these are made at the end of the month. So during the month, they represent a liability. Liability, why? Because you have to pay it at the end of the month. Once the finished goods are ready, the goods are sold and delivered to the buyers. The payment is not received immediately, as mostly goods are sold on credit. The amount of goods sold on credit is called a receivable, current asset. As the debtors, the individuals who had bought the goods on credit begin to pay the company. The cash and bank balances increase. Okay. So this is a more detailed snapshot of the working capital. And so cash and bank 10 lakhs, 1 lakh, sorry. Raw material, even if it is bought on credit, it is shown here. Because the credit part is shown here. So raw material, whatever raw material is there, the value is taken, 40,000. Finished goods, the stock of goods produced during the year. Remember, these are all yearly figures. Finished goods, 160. Accounts receivable, 2 lakh. Gross working capital, 3 lakhs. Current liabilities, accounts payable, payable to suppliers, 1 lakh. Normally, these are payable within 30 days. Salaries payable to employees, 70,000 to be paid at the end of the month. Bills payable for utilities like electricity, fuel, etc. 30,000. Total is 2 lakh. So your net working capital is 3 lakhs minus 2 lakhs. This is 1. So this ratio that I'm showing you, where the current assets are 3 and the current liabilities are 2, this is critical. This, you always should be having more current assets than current liabilities. Because if that is there, then you will never run into a cash flow problem. You will not run into a liquidity problem. Liquidity problem means that a firm is short of cash. And if you are short of cash and you are unable to pay your suppliers, people whom you have bought goods on credit from, it will spoil your reputation. Once your reputation goes, people will never sell to you on credit. So you will need more money to do the same business. See, right now what is happening is, as long as your suppliers are willing to give you goods on credit, that big advantage for you is that you don't need your own money for those things. They are giving it to you on credit. All that you have to do is take the goods from them, convert it into finished goods, and then sell it, get your money, pay them back. Okay. Now there is no need to part. We will take a slide. Let me just. I'm sharing my screen again. What I'm showing you now is the last thing that we will cover here. So basically these are called, so we basically talk about business models, different models of doing business. So business model is the plan a company comes up with to make a profit. Suppose you want to start a business tomorrow. So what is that plan that you have which will ultimately result in you making a profit? So the business model basically will answer three questions. First, what product will the company make? Or what service will it provide? One. So there are two options. Now, you can either produce something or you can provide a service. Okay, fine. Two, who will buy the company's products? Let's say you're starting something today. So you need to answer these questions. First one is, what will you make? Or what service will you provide? Who will buy the company's products? I'll give you an example, business model. When I was teaching here in MBA, one of my students during COVID thought of a very simple business model. Now, this girl, she was a classical dancer and she was confined to home during COVID. When she put her MBA to some really good use, what she realized was that there are a whole lot of people all sitting at home who may be interested in passing time by learning a bit of, let's say Bharatnatyam. Because see, you have no other ways of engaging yourself. People are working from home, but what about the rest of the time? There's nothing to do. So what she did was, she advertised herself as someone who will be demonstrating Bharatnatyam, the basic moves, online. She got herself a camera, built a small studio in one of her... Studio means what? One space in her house. And she was in Lucknow, I remember. And she basically got someone to, take a camera and film the whole thing. And she videotaped it and put it out on her YouTube channel. And it was a paid thing. You subscribe to it and you can learn. And she was telling me that it caught on so well that she was able to convert COVID into a business opportunity for herself. What was her model? So the model is very clear. The service she is providing is a dance tutorial. The way she is doing it is through a video. So the expenses are practically negligible. The channel she is using is YouTube. Once again, free. All she needs is to have a broadband connection. And the market she had was essentially the world. Anybody interested, sitting at home, who is aware of classical Indian dances, and somebody there, let's say a male or a female, interested in actually learning this. With people having no other engagement, this became an excellent opportunity for her. And this was her simple business model. How will people pay? She set up a system where you send the money to her, and that's it. And she was actually running an international business from home. This is a simple business model. It also answers the question, who will buy the company's services? What is the service the company is willing to provide? Now, if it's a manufacturing thing, what are the raw materials and how can they be procured? If it's, let's say, one of those things where you need to produce something physical, where will you get these raw materials? That the supply chain part, that will be part of your model. Then what are the human resources needed to produce and market the product? Now, in my student's case, she did not need any human resources other than someone to basically hold the camera. That's it. Nothing else was needed. But in most businesses, more people will be required for different aspects of the business. Now, the next part is what will be the marketing and sales strategy. What was her marketing and sales strategy? She was basically publicizing herself on Facebook, Twitter, that. So basically using social media to promote herself or her little business. That was her marketing strategy. What is the marketing strategy of most other companies? So they have multiple ways of doing it. They would be using social media. They would be using TV advertising, newspaper advertising, the conventional forms, hoardings, all that. Any way of increasing the visibility of their company. That is what they basically are doing. Now, will the company use a chain of distributors? How will you sell? Are you going to have wholesalers? And you actually, from your factory, the goods will go to wholesalers, and the wholesalers will then send it to retailers, who will then send it to the end customer? Or is it going to be some other model where you will send directly to your customer? So it depends how you want to do this. Old model businesses would always rely on wholesalers. For example, if you want to buy paint, let's say you want to buy you got some painting to be done at your house, and you want to buy some paints. And you decide to buy, let's say, Asian Paints. They have a huge range. You want to buy theirs. You go to one of their shops and you want to buy it. So typically, you will be going to a retailer who will be picking it up possibly from a wholesaler. And Asian Paints would be providing it to the wholesaler, who will provide it to the retailer, who will provide it to you. Because the volumes are huge, so they need to have a channel. So depending on the business that you have, you may not need a wholesaler or you may need a wholesaler. It depends. Okay. Will the company market exclusively through online resources like Amazon? You can do it this way also. You don't have any wholesalers, do it directly. You have an account with Amazon as a seller. Orders are generated there, and you basically just make sure that you fulfill those orders. Sell the goods to the people who asked for them. Now, another question is, what is the value proposition? And then, of course, the big question, what is the amount of investment that is required? Once you answer this question, what is the amount of investment that is required, you are entering the world of finance. Where will you get the money for it? What are the assets that you have to buy? What are your current assets, liabilities? That whole game will start. But up to this point, so a value proposition is a concise statement of the value that the company offers through its goods or services. So, for example, the girl I was talking about, who, let's say, did so well with the dance class, she basically, what was the value proposition for her? What is the value her customers were getting? They were learning how to dance. Value proposition, they want to learn how to dance. And they are learning how to dance. Okay? So they are learning how to dance. That is the value proposition in that case. If you're selling something where there is a lot of competition, then, for example, you take a classic case, you have you have iPhones, and let's say you have some very high-end Android phones. Let's say you have a OneNote. So you try to think of what is the value the iPhone guy gets, what is the value the OneNote person gets. Same, yeah, what is the value there? Functionally, probably the same. Design, it's a matter of choice here. Some people may prefer the way an iPhone is designed. Others may prefer the way a OneNote is designed. But there will be a section of customers for each. That is why both generate lots of sales. So value when you buy a mobile phone, what is the value that you're getting? First of all, the functionality of the thing. All the things that a mobile phone does, this particular mobile phone that you buy, how well does it do all those things? Is the sound quality good? Is the camera good? Does it have, a notes facility? Can you, surf on the net properly with it? And of course, the most basic thing, can you, send messages, make calls, do all those things properly? What are the apps that it supports? All those things will come in. So that is the value for you. So whenever you're making a business model, you'll have to ask yourself this question, whatever I am giving, what is the value that my customer is going to get? Basically, it's answering this question. Why should a customer buy my company's products or services? He should have a reason to do this. That is the value. The proposition or statement is made in such a way that the customer feels that it is better to buy this product rather than other similar products in the market. So maybe the proposition is like this, okay, there are lots of other products in the market, but none of them are priced at the price point I am giving you. So for you, the value is you will get something equally good, but you will get it at a lower price. That could be one value. Or the value could be nobody has such a unique design as mine. You pay more for my product, but we give you something really unique, something which is not there. Nobody else is going to be having it. That is there. It is critical, this value proposition thing, because your whole marketing is going to depend on this. So the value proposition essentially has three components. One, the target market. Identify the customer segment that is likely to buy the product. Identify the key demographics: age, single individuals or families, high, low income level. Whatever value you're giving is going to be linked with this target market. The same product will have a value for these people you're targeting. It may not have an equal value for other people. What is the specific value the product offers? It can be best quality, lowest price, best design and style, very quick service, something. What is it that it's offering? Customer connection. The marketing style must appeal to the customers. It should connect emotionally with them. See, if you recall advertisements, there are some advertisements which make an impression on you. And you tend to remember those ads. And then you tend to, because you remember the ads and because you feel that, yes, I remember Tata Steel used to have an ad which used to say, we also make steel. I don't know whether you people have seen this ad or not. This was a long time back. It used to say, we also make steel. And the impression it made on me was so strong that even today I remember that. What they were trying to say is that we are more than a steel company. We give back so much to society. We do so much for the country, for the places where we operate. And so we do much, much more than just make steel. Now, this is like they were creating a certain image of their company, of their brand, which was then helping people to get a good image of Tatas and to buy their products. This is value proposition. One part of it. This is a intangible part, but it's there. when I buy their products, I'm actually supporting a company which is doing a lot for people. If I have this impression, this is how it will actually help me. Okay. Now, these are, so here's an example from Firolex pipes. Firolex pipes generally says that we have pipes which are the best quality. Their basic point is quality. So their target market are basically builders of commercial and residential complexes. And then there are individual customers who may want to replace a pipe, if you are actually doing this. The specific value proposition, the best. Of all the pipes in the market, these are the thickest, most durable, best for the building in the long run. So they explain to customers why they are not the cheapest in the market. They are not saying we are the cheapest. Lots of other pipes are there, which the same thing will be available at a lower cost. What these guys are saying is that those pipes will not last as long as our pipes. Customer connection, how do they do this? They get together for builders and individual meetings through their sales teams. They make presentations on the quality aspects of their pipes. They show the good customers that they already have. And then they tell you one thing, we've been in this business for a very long time. And people have found us reliable. We have a brand. So when we tell you that we are good and we make good pipes, please believe us. They try to connect with you like that. So that's that. Now, let's look at some types of business models. Simple. Traditional business models, direct sales, franchising, retail, brick and mortar store. Brick and mortar stores means simply a physical store. All the shops that you see. You walk into a pantaloon show, the physical presence. Direct sales, company has sales agents who sell directly to customers. There is no retail shop location. So there are no physical shops. One typical example here is Eureka Forbes. They don't have shops, specifically for Eureka Forbes. What they basically do is they have agents who go around and sell. Franchising. The company sells its business model to a franchisee. For example, Subway, McDonald's, Pizza Hut, this sort of thing. It's a simple thing. There's a franchise. They will give the way they make, let's say, a burger, it's given to the outlet there. All outlets will essentially make the same thing, do things in the same way. That is their signature. You can immediately, they will look the same. They'll have the same signage. Everything is the same. What does the company get? It gets a license fee for the franchise. It is allowing them, these different shops in different parts of the metros and in the smaller towns, to actually sell burgers using all the good practices that they have developed. In return, that guy can keep the profits, but he has to give a certain part of those profits to, let's say, McDonald's. That is a franchise. Then there's a subscription model. Come down to the e-business days. This is done where customer acquisition costs are high. The customer subscribes to the service provided by the company and pays an annual subscription fee. So one example, credit information companies. You have, let's say, banks want to know about how good my customers are. If somebody applies, they want to have your rating. What is your credit rating? So when, let's say, you go to, so in those cases, the bank is actually, they go to, let's say, a company called Equifax. What that Equifax does is, it creates it gets data from banks, from all sources, and tries to create a financial picture of the customer, of anybody. So, and each person is given a score. So, when the score is there with the bank, they know that if a person has a score of, let's say, over 600, he is credit worthy. I can actually give him a loan. Now, how does this work? The bank will subscribe to this service. The bank will pay a certain amount of money for this service, and every time they want to check the credit worthiness of a customer, they will go to the website of that particular company like Equifax and get the details from there. Okay. Then you have what are known as freemium models. What is a freemium model? So these are advertising-based business models. The company provides free services or information and earns revenue by selling advertisements. You take YouTube, for example. You go, you listen to a music video. It's not charging you anything. Anybody can go and listen to it. But how does that particular channel earn? It is getting ads. So before you actually listen to your music video, you have to, that ad is there, maybe about, it will say that you have to, let's say, it's a 1 minute thing, you have to first see it, only after that. Or it might give you an option to skip it after, let's say, 10 seconds. But in that 10 seconds, at least they will beam their product at you. You'll be able to know what they're advertising. And that is the cost that is required to see that particular thing. So they earn revenue that way. Okay. Then you have the e-commerce, buying and selling of goods and services over a digital and electronic network. E-commerce revenue to grow to 111 billion by 2024. When I was making this last year, this was what was projected. In here, you have what are known as B2B models, business to business. These are marketplaces to connect businesses. Both sellers and buyers are businesses. The minimum order size has to be large. That means this is not like, one side is retail and one side is a business. Both sides are basically dealing in bulk, like two businesses operating with each other. Acha, Kedar, you're saying that bricks and combine not understood. Okay. Bricks and mortar is a physical shop, actually. And let's say you also have an online presence. If both are there, then that is a combination. That is the idea. See, typically you can have an e-commerce business or you can have a brick and mortar business. But there are some businesses which do both. They have shops also, and it is also available as an e-commerce thing also. For example, Amazon has shops, not here. It has them outside India, physical shops. And Amazon is there as an e-commerce portal also. So that is like a combination of both. That was the idea. Okay, coming back to this, B2B models, these are marketplaces to connect businesses. Both buyers and sellers are businesses. Please, this is the point here. Buyers can request for quotations. Example, IndiaMart.com, IndustryCard.com. These are B2B. Note, the company that is running the marketplace is a B2B model. The sellers of goods are selling to businesses using the marketplace. These sellers are also another example of a B2B model. As long as both sides are businesses, not individual customers, it's B2B. In India, there is one legal aspect to be noted. The entity that is running the marketplace, example, IndiaMart.com, cannot be one of the sellers. it cannot produce and sell its own goods on this site. This is something, a law which has been made in India. It's not applicable in many other places. B2C. This is an inventory-based business model. This is a virtual version of a brick and mortar store. So basically what you're doing is you produce something, you keep a stock of it, you have an inventory of it, you invite people, customers, individual customers to send you orders, you get the order and you fulfill the order. You send that goods to him. That is B2C. Okay. In this model, the seller sells to anyone who comes to his website and places an order. Okay. Okay. Now, see, if you want, you go to a site called Shopify.com and check out the way a seller can use Shopify to create his own website and sell goods. Let's say that you have something to sell and you want to create a website of your own to attract customers and to generate orders. So there is a website called Shopify. You can go there. It will help you to make a website and it will allow you to present yourself to customers who are interested. They can place orders on that website and you can send the goods to them. This is typical B2C based on inventory. Okay. Now, B2C models can set up their own website and use its own marketing techniques. Think of Lenskart, Chashma wala. People who so it's possible for you to go to a Lenskart website and place an order for you can take your prescription, you can upload it there. They will make your spectacles for you and send it to you. You just have to select what frames you want, what exactly you want. And Lenskart also has a physical brick and mortar store. So this is, like it's combining both. So Lenskart is offering a large number of products for sale. These can be bought directly from its website, or you can go to its store and buy it. Now, B2C, non-inventory based models, business to customer. You take Amazon. There are businesses and the customers are you and me, all individuals. Sellers of any product will sign up with Amazon and agree to sell their goods on the site. They will also agree to the conditions laid down by Amazon. And then, so if you go to this particular link, now you can look at the FAQs there from a seller point of view. What do they want from the seller? All those businesses who are registered on Amazon, and ultimately you buy something from one of those businesses. What exactly does Amazon expect from them? What are the terms and conditions? You can go here and have a look. Then you have what is known as a C2C business model, customer to customer. In this model, a third party creates a website. Any customer can register on the website as a buyer or seller. The transactions are done on the site and payment is made through the site. Delivery is made by the seller. So here you can be a buyer today, you can be a seller tomorrow. What is an example? Can you think of an example? Anybody got an idea so far? Okay, here's your example. OLX. Okay, simple. You want to sell something, you go as a seller. You want to buy something, you go there and buy. So magicbricks.com. The same thing, selling, but this time it's property. And then finally we come to business level strategies. But I think I'll send this to you. But basically, as far as understanding what I'll be doing in this course, this, what we've covered so far today, this is more or less what this covers two aspects. It's giving you an idea about the finance. It's giving you an idea about the accounts. Apart from this, I'll also be covering financial planning and wealth management. Now, financial planning and wealth management, the parts which I do for that will essentially relate to your personal finances. And it will develop an understanding for you about the different assets that are available and where you can, like insurance, equities, mutual funds, exchange traded funds, gold, alternate investments, all that, which will give you a very good idea about personal finance and wealth management as a whole. So I hope what I've done in these 3 sessions has helped you to understand what the course that I bring here is going to give you. So this is a sketch, all these things that we've done and lots more that we'll do in detail if you register for the finance one. Now you probably already registered. So if it's finance which you're doing, we'll be meeting again. I think the regular sessions will begin sometime in May. And when we do start, those of you who will be there, we'll be meeting regularly for the next 3 or 4 months. And that I can assure you, by the time you're through with those 3-4 months, you will have a fairly good idea about most of the basic financial issues which you will be faced with in due course. Okay. So I will send this presentation to you today and make use of it. Whether you're doing this course, you're not doing this course, doesn't matter. You make use of this and sort of empower yourself with some more knowledge, some basic knowledge. And those of you who will be continuing on this journey in the financial journey, hope to see you again in May. So thank you so much. And I'll end it here and I will be sending this to you later tonight. So bye everyone. All the best to all of you.